Hello, once again, my name is Troy White, and I am a portfolio manager with the firm Hoodoo Financial. Please like and share this video. Please subscribe to this video and share the video. Also, what else I was gonna say? Share the video, like it, subscribe to this YouTube channel. And so today we're going to talk about stock market investing and just cover a few just I just have a few notes. I'm going to highlight some points and just talk about them. And first off, I think this just popped into my mind just right now. As I just said, I'm a portfolio manager, and I was asked, okay, well, what is that? And there's really a weird answer to that because it depends on my client and what I'm doing for my client. Because in terms of the title, it's pretty much insignificant, but the description or the title really is different depending on the client. So let me go over that right quick. First off, if you are a client, but not necessarily you don't necessarily have a lot of assets, and you are just doing a little bit. It's hard to define what I'm trying to say, but basically, and for lack of a better word, let me put it like this: if you're sort of broke, or broke is not really a good explanation. If you're new to investing and you just need some advice, then and you are my client, then I am your investment advisor. All right. Now, if you are a client that is an investment client that has some concern of your overall financial condition, you are interested in knowing if you are covered adequately for in terms of meeting your goals, if you are on target to achieve them, and you are someone who wants to make sure that you are doing the right things uh, from an investment standpoint and financial standpoint, and you hire someone like me to help you determine, how you are doing and to get on track, then my title would be financial planner. Then I am your financial planner. All right. Now, if you are a client that is doing not just investing, here and there on your own, you have some financial planning completed, whether it's by me or someone else, and you have identified your goals and how you plan to achieve them. And now we are implementing a strategy that you've already devised by the use of financial planning. Then we are creating a portfolio. In that situation, my title or my role would be I would be managing the portfolio that we are building, creating, or have created. So I will be your portfolio manager. And then let's say that you're not just out here investing on your own. You need guidance, and you have completed or are engaged in financial planning, and you have created portfolios, and those portfolios you are investing into on a regular basis, and they are accumulating, they are appreciating. And then in that scenario, you have multiple investment products, meaning there's some insurance, some stocks, bonds, mutual funds, ETFs, according to a plan, and we're doing maybe even real estate investing as well. Then you have accumulated some wealth. Then in that case, my title would be wealth manager. So I'm doing the same thing, right? But I can't do some things for you if you have not progressed in that through those channels, from basic financial advice, basic financial literacy, basic financial planning, basic portfolio building into wealth management. Now you have something that needs to be managed. So there's a continuum there. So that's just to give you some breakdown on the roles for which I play, or which when you hire someone, what do you call that person? And that it's not like I have a sign over my desk that says wealth manager or portfolio manager or financial planner, investment advisor, financial advisor, uh, real estate coach, investment coaching. There's no begin, there's no end. It just, depends on the need of the individual. All right, so let's dive into it a little more in terms of stock market investing. So, custom portfolio building, that is what we do. So, what does that mean? So, first off, what's a portfolio? A portfolio is a group of assets that are yours. So, if we were to, I'm just making this up right now. If you had a basket full of fruit and all different sorts of fruit, then that is a portfolio of fruit in the basket. So that, a lot of times you may have think of portfolio when there are models. A model will, in fact, I'm going to use that same term, models, when in finance. But right now, I'm talking about the fashion models, right? So when a fashion model goes to try to get a new assignment, and she brings her portfolio to the photo shoot or to the audition. So those who are, deciding whether she's good or bad is going to open the portfolio and look at what she has there, what she has accomplished, he or she. And based on that portfolio, they'll make their judgment. So in the case of your investments, a portfolio exists in your investment account, and it is a accumulation of stock symbols, right? So stock symbols are the symbol refers to the company. So let's break it down a little more. Let's say you have a portfolio that consists of tech stocks. Those in that portfolio might exist something like stocks of Apple Computer, Microsoft, Google, Samsung, Motorola, Logitech, um, Intel. I'm just trying to think of all the tech. So just that right there, just those. So you may have 100 shares of Apple, 100 shares of Yahoo, 300 shares of Google, and so on and so forth. So when you look at it all together, that is your portfolio of assets. And the intent is that that portfolio, and specifically each of those companies that you own inside your account, which we're calling a portfolio, we want each of those companies to appreciate in value. The day you bought it, is $10 a share. And, at some later date, we want it to be $20 a share. And then we want it to be $30 a share, and then 40, and then 50. But I shouldn't use those type of prices. Really, in reality, we want it to be, you bought it at $10, and tomorrow it might be $10.50. And the day after tomorrow, it might be $9.50. The day after that, it might be $11. The day after that, it might be $8. The day after that, it could be $12. But we want to see this consistent, slow growth. In addition, there should be a regular amount that you are investing into your portfolio of stocks, portfolio of assets, because it's not like a car. You buy it and you just hope that car just appreciates. Yeah, it will, but we want your portfolio to grow. Not We want the assets to appreciate, but we want your portfolio to grow. So your portfolio grows by regular, steady, consistent investing. And you're investing in a manner that is called dollar cost averaging. That means that regardless of where this stock is selling at, whether it's $10 today, $12, or $8, you are investing a set amount on a regular basis, doing this consistently. So, for instance, you are investing $100 on the third of the month, every month, all the time, consistently. So, this is helps you fight against volatility. Volatility just means the ups and downs of the stock market. So that means one day it was, like I just mentioned, one day it's $8, then it's $10, then it's $12, then it's back down to $9, then maybe it's up to $13. That is volatility. That means that the price is pretty volatile, meaning it can shift, easily. And so dollar cost averaging means that with that volatility, that up and down, and like I mentioned in that scenario, we're going to invest on the third of the month. Let's just say hypothetically, volatility on the 29th, the stock was at $8. On the 31st, it was at $12. On the first, it was back to $10. On the second, it was back to $12. On the third, it was down to $9. That's actually great because that means you just bought it dollar cost averaging. You bought it lower than the recent high of these recent days, right? So then, after the day you bought it, meaning the third, let's say it goes down to $6 on the fourth. And then on the 10th, it's back up to $15. So on the 4th, if you are someone who monitors your account and gets terrified when you see these ups and downs, you get a snapshot that on the 4th it went down to $8. You feel like you are losing money, but on the 15th it made it up to $15. But understand that you still own that asset, and it doesn't matter what the market value is at that time, because you should only invest in that asset if you felt positively about the company, and you felt that according to your time horizon, this stock will appreciate according to your needs. If your time horizon is 5 years, then and you feel that in 5 years it will, you're looking for a 20% gain, appreciate 20% over 5 years. The Dang, I'm gonna have to call her back. So you then at 20% gain, then hey, that's success. So, but if you pull the trigger and sell because you saw it go down to 8, that means that you're falling in line with what most Americans do. Most Americans are losers in the stock market because they buy it high and they sell it low. So that's why you should dollar cost average. Don't try to save up thousands of dollars and then buy a stock. Just invest consistently on a regular basis, a set amount, a small set amount, dollar cost averaging. That will give you a better average cost for your dollar consistently. All right. So, and then I'm going to speak on asset management and wealth management, asset management, portfolio managing. This is all similar. It's just different names, different adjectives for the same activity. So you have assets and they need to be managed. You have wealth and it needs to be managed. You have a portfolio and it needs to be managed. So there are some differences. Technically, we could pull out, well, this is a portfolio and this is asset and this is wealth. So there are some nuances, but fundamentally, you need someone, a finance professional, to help you in some sort of way to manage those assets. And when I say manage them, you want to you need them monitored. You need a method to continuously accumulate more, and then some advice in terms of when you have questions, or maybe if you just need advice in terms of uh, what actions you should take next. And so asset management, and then affordable asset management. Let me talk about that a little bit. Fundamentally, wealth management, asset management, portfolio management, doesn't matter what you call it. There is a requirement that you have wealth for that professional to manage. And when in the industry, in the financial services industry, we designate the term wealth is means $500,000 of investable assets. Sometimes you can get in the door with 250,000 of investable assets, but fundamentally, you need these large sums to invest. So usually this is accomplished by you rolling over your 401k into an account so that someone like me can manage it. So if you don't have if you haven't accumulated any wealth, it is highly unlikely that you are going to be able to utilize the services of an individual like myself. And the services of an individual like myself are highly dependent upon software tools and back end infrastructure that dictates that I only help people who have these large amount of assets. And at our firm, we don't require that you be wealthy for us to be able to help you. We want to help you accumulate wealth. We want to help you build a portfolio. We want to help you grow assets so that we can manage them for you. Because there is a retirement crisis, there is a wealth gap in America. So if I only work with people who have assets already, wealth already, I'm not going to be working with and helping those who I entered this industry to help in the first place. So I had to find software tools, asset custodians, and service providers that are willing to allow me to provide this service to people with minimal assets. And when I say minimal, I mean $25, because I allow my clients to enter to have access to these services to start with $25 a month. So what that means is there are rich individuals. So I'm just going to pick a celebrity that I do not know, and it does not. This person who I'm about to pull out the air does not have an account with me. Just to set that off. So let's say Shaquille O'Neal. Shaquille O'Neal is wealthy, and let's pick somebody that's not as rich as him. Let's say some singer or something. Let's say a singer like, let's say Tank, right? That dude or is probably, I mean, we always assume that artists have money, but I know differently. But let's say he has $800,000, and maybe in some assets, maybe he owns his house outright and has 800,000 investable assets. So someone like that will have access to the financial tools that I can provide them, or that larger firms can provide them. But those tools are not accessible to somebody like you. And when I say somebody like you, someone who, every time you shift to a new job, you cash out your 401k, you have not got any life insurance, and you only have a savings account, and you have about $1,500 in your savings account. And but you have a good job, you cover your bills, and you pretty much buy the things you want. You live pretty comfortably right now. Well, someone like you doesn't have access to wealth management, period. So someone like you can come to our firm, open an account, and invest through dollar cost averaging $25 a month. And in doing so, we will build a portfolio that consists of, literally, we could have up to 100 different stocks in your portfolio from day one, and you only have invested $25. We'll start building your portfolio right there. But I'm not trying to get clients who don't want to help themselves. So in part, that's why firms don't allow this type of service, because most people just, oh, okay, well then I'll just do $25. And but I'm trying to get you started, but if you're not trying to help yourself, then don't waste my time. So that's a little bit on affordable asset management. Now, let's talk about the trading technology. We touched on that a little bit. Basically, technology completely is the reason why I am able to offer this to you. Wealth management services, where previously, like I say, you had to have $500,000 in investable assets before you can even come in the door. Well, trading technology has changed this game. And so I'm a finance nerd, and I've been in financial services for a very long time, and very, very, very long time. And so my introduction to financial services started with the dot-com bubble. I was a stockbroker at Scottrade, and that is the beginning of the time when the common person had access to investments at their own fingertips. So because first off was E-Trade, and then was Schwab, and then was Scottrade, and then Ameritrade, and some other firms that that are financial planning uh, fundamental firms, they started allowing account sizes that are smaller because more people were having access. So, they would open the doors for more people. And those firms are like what I said. I said Ameritrade. I really meant TD Ameritrade. Oh, I meant Ameriprice is one. TD Ameritrade, but there's another one um, that started off as it's that credit card that you have to pay the whole amount. American Express. So first it was American Express Financial Services, and then they changed their name to Ameriprice. And then there's Primerica, which I don't want to disparage them, but that's kind of a multi-level marketing. So 99% of the time, individuals who are selling the services at Primerica are not finance professionals. They are basically just, they can fill out the paperwork and get you what you need, but they don't really know how to really help you in an in-depth way. But you can have access to some financial products through them. But anyway, on the trading technology, uh, uh, so like I said, years ago, my entry into financial services was through these online trading firms. And after the dot-com bubble burst, then you know, I, that's when my I start diving into the technology aspect a lot more, and increasing my knowledge and on the technology. And so now I'm fairly sharp on technology related to financial services. There are a lot of new developments, and fundamentally, the reason that I've been so much into the technology is because I always had the vision to provide the services, and so I wanted to go. It's another long story, but I realized that I had to do an end run around these other firms because they don't have the same goals to provide services to my community. And so, but I knew that, hey, I could access this technology myself. So, as these large firms, right now, the largest firm you can name, I can provide you the same thing they can. And it's because of technology. It's bottom line, just access to the technology. So anyway, trading technology has allowed me to offer you fractional shares, dollar cost averaging, any account type, including investment club accounts, corporate accounts, um, 401ks. If you are a corporation and you want to provide retirement plans to your employees, I can provide you with that as well. Um, and so this allows me to do customized portfolio building. And we do that through fractional shares. Like I've mentioned all of that already. And so what are fractional shares? Fractional shares allows me to build you your own mutual fund, but it's not mutual because nobody else will have it. It's a private fund. It's a customized portfolio. So um, by investing in a fraction of a share. So let's just, for simplicity's sake, say there's a portfolio of 10 stocks, and let's say each of those stocks are selling um, at between let's say $30 a share and $50 a share, but you invest $100 a month. So when I was a stockbroker at Scottrade, if you wanted to get a share of this particular stock, then the stock is selling at $50 a share, then it's going to cost you $50 plus $7 commission to buy that. It's not a commission, it was a fee. $7 fee and then $50 for one share. Well, first off, through using our tools, I can provide you that, I can make that trade for you commission free. So you're not paying a commission to buy that share. And also, well, you don't have, like I say, you only got $100 every month because we're dollar cost averaging. Remember to fight against volatility. So what we do is we're going to take that $100 and we're going to buy a fraction of each one of those shares, those 10 stocks. We're going to buy a fraction of that with the $100. So $10 in this one, $10 in that one, $10 in this one, $10 in that one. And so then you might say, well, what good is that going to do me if I'm only getting a fraction of this share? Well, if you would have spent the whole $100 on one company, first off, you're going to have to spend $107 because it's going to cost you $7 to place a trade. All right. So you say, all right, it's not that bad. Well, we're only going to buy 2 shares, right? Well, when that company, if their stock were to rise in value, it's going to rise by a percentage. So if I had a fraction of that, my fraction still is increased by that same percentage. So it doesn't matter if I had $50 or 50 cents invested. It's still going to raise by 2. If that stock increased 2% today, then my 50 cent increased 2% today. Or my $100 increased 2% today. And let me point out to you that an investor who is investing millions of dollars, I want to point out to you, I don't give a damn what's happening with him or her. I give a damn what's happening to me, right? That's how you should think. Why are you concerned about what's in Jay-Z account? I get sick of hearing that. Oh, he got money. Oh, that dude is balling. So what? What are you doing? Why are you concerned with what's in his account? When Jay-Z or some other celebrity goes on vacation, are you deriving some satisfaction from his vacation? When he's riding in a nice luxury vehicle, do you feel the same luxuriousness in your seat, in your car, that he is experiencing? No, you do not. What he is doing with his life and his accounts and his portfolio is irrelevant to your entire existence. So get that in your mind in the first place. So if he got $100 million in his account, and that doesn't matter to your $100. What's more important to you, your $100 or his $100 million? This is a very important concept for you to get. So we could, if just harping on that scenario for a minute, if we knew what Jay-Z is invested in, we say Jay-Z say, oh yeah, I have such and such mutual fund. We could go and look at that mutual fund and pick those exact stocks and have them in your portfolio. So every time Jay-Z stock go up, your stock go up. You've heard of what's his name? He was Berkshire Hathaway. I can't even remember this guy's name right now, but this millionaires, right? Billionaire. He's a billionaire. I can't remember his name, but anyway, whatever he's investing, I have his portfolio in his stocks in our portfolios, in my models, portfolio models. So, and I said I would mention the model. So I start off with a model portfolio. So I've modeled various portfolios that I monitor on a regular basis. And then when you come to me as a client, I have models to choose from. So then I understand through financial planning what your needs are, what your risk tolerance is, and what your time horizon are. And then I'm going to select a model that matches your investor profile. And we adjust that model or customize that model to fit your likes and dislikes, the do's and don'ts that you insist on, or just the subtle changes that I feel are needed for your portfolio based on starting with that model. So so through fractional shares, we are able to do this, and we're only able to do the fractional shares based on the investment technology, trading technology. And so I mentioned fractional. I mean, I just mentioned risk tolerance. Risk tolerance is at the basis of what we do for you, and that's it. Just break the word down. Tolerance of risk. How much can you tolerate? And so there's a risk reward trade-off to everything you do with your dollar. There's an opportunity cost, meaning you could be doing something else with your dollar. And then there's a risk reward trade-off with what you do with your dollars. And so based on your risk reward trade-off, meaning your risk tolerance and the financial planning that we go through, that's going to dictate the type of investments that we are going to select, and the direction that you are going is, are we going in growth funds, income funds, value fund, or basically that's a type of investing. Are we looking for stocks that we believe are currently undervalued? That's value funds, value investing. We're looking for value. We think that this stock should be selling at $12, but right now it's selling at $8. That's a value. Income portfolio. That means are we looking for stocks that are known to give off dividends? That means they produce some income to your portfolio. Or are we looking for growth, meaning stocks that we feel that since they are selling at $10 a share now, we think this company over the long term is poised for a lot of growth, and they have great products, and they have a great pipeline of products that they're going to be putting out. Then we feel based on that it's selling for $10 now, but it's going to be selling for 20 later. That's growth. And the types of a type of companies are broken down into small cap, mid cap, large cap, micro cap, and that means their capitalization. That means how much money they're working with. I mean, what's the value of this company? Um, Micro cap is I don't want to go into explaining that too much right now, but basically, I like micro cap growth stocks. Those are, think of a company like Apple Computers. Right now, that is a large cap stock, but think about them before they were a big company, before we even knew their name. They were a micro cap. So if we were to find this a company that's micro, their capitalization, and there's a specific dollar value that separates each category, and I don't have it committed to my memory right now. But so let's say this company is a micro cap, then We believe that, hey, they got some products that right now they're a little company, but what they're doing in 20 years, they're not going to be micro. They're going to be large, larger than large. Then if we would, so similarly with Apple, if we get into it now, when they first started off, then later on down the road, it might be the biggest company known to man, like they are right now. So that impacts the way we invest our dollars and the types of companies that we're looking for. So basically, building a portfolio based on these various criteria and that I've mentioned so far is what allows us to build a portfolio and you become a real investor versus a stock picker. Stock picking versus portfolio building is, it's the difference is night and day. It's the difference of like, um, you know, you got a hoopty versus you got, a fleet of luxury vehicles. Um, that might not even be a good analogy, but it gives you it's a good picture to have in your mind because a stock picker is, basically if you have an online account somewhere, let's say, and you are a stock picker, what you actually are doing is are just letting your money grow, and then once information comes to you over time, you say, oh, you hear about, oh, Starbucks stock is up, and then you say, oh, how much money do I got? Oh, I got $1,000. Okay, let me buy some Starbucks stock, and you'll buy that stock, and then you won't buy another stock for a while. Until you hear another tip. Oh, Microsoft stock is up, and then you say, oh, how much money do I have in my savings? Oh, I got 500. Let me buy some Microsoft. And so you just do this repeatedly, just over time. You get a stock tip, and then usually through the media of somewhere, and then you see how much money you have and you invest in that stock. So this is how people buy high and sell low, because understand that by the time you get that tip, this is you are literally being told that this stock is up. That means it's high now, it's at the high. And so you are buying high. And so what happened is when you're going off this type of information, you're going to hear another tip at some point and say, yeah, Starbucks is down because you know they did something bad, right? Or it's oversaturated, and so they're going to sell off some stores or something, right? And then you say, that's bad. Maybe I need to sell. And then you go and sell. And what you also didn't do is continuously invest into that stock. You bought one lump sum. So whatever it does is what it's going to do. You bought that one shot and you're like, all right, you're watching it like, okay, what you going to do? Is you going to go up or you going to go down? And that's not how you should invest. I mentioned earlier, dollar cost averaging allows you to consistently invest into these assets that you shouldn't invest in it in the first place if you don't feel it's a worthy stock. And just investing on tips is not good. Investing on tips is what most Americans do, and most Americans buy it high and sell it low. And by doing that, you got the tip. The tip was, oh, the stock is up, so that's why you bought it. You'll never get a tip that says, oh, the stock is down, this is a good time to buy it. That's just not what you hear, and it's not something that is pleasing to your ear. It's not something that you think to do. It's counterintuitive. You should to buy low and sell it high, but that's just the way that it's an emotional market. Most Americans, solo investors, online investors, they buy on the emotions. They are part of the emotional market. So, you rush to it when you heard, just like when you see everybody else running to the fight, you run to go see it too. And then when you think the fight is over, or when it's a new attraction over there, you abandon this one and run over there. But that means you bought it up here, and then when you know it's no longer interesting when it's down here, you leave down here, and then you go buy something else high with the lower dollars that you now have. You buy something else high, and then when that goes down, you sell that, and then you go buy something else at the height. So you started off with these dollars and you are slowly decreasing your assets. And then you get upset with investing. It's like, I don't fool with the market. I don't fool with the stock market. And so you'll hear people do that, and you'll hear what I hear. I work with my clients on the stock market, on real estate investing, and on entrepreneurial pursuits, right? Investing in their companies. So what I know, what I see very common, I hear the words very common, is people have bought high and sold low so often they are turned off by the market, and they invested when in their home, their personal residence, when they bought a house, they see that, oh, in a few years I now have equity in my house. And so they think that's a great investment. But what they don't realize is that you have been dollar cost averaging into your own residence. You slowly invested into this property. But the your residence actually appreciated at a less percentage than many of the stocks that you bought high and sold low. So you could buy that stock high and sell it low and be totally turned off by that. But I could show you that this stock symbol year to date has gained more percentage increase than your residence year to date has done. And the reason you think you gained is because you didn't have the same emotional reaction in your residence than you did in your stock. And you think you got more money, but that money is inaccessible to you. It's in the walls. It's in the walls of your home. So it tricks you into thinking a different way. It's to thinking that you made a wise investment decision in the home and a bad investment decision in the stock. Now, I'm not against real estate. I help my clients with real estate investing, but real estate investing, not buy a house and think that you living in it and that's going to be the end all be all. So anyway, that's a little bit on stock picking versus portfolio building. Portfolio building consists of multiple assets. You might have real estate and stocks, bonds, mutual funds, ETFs, cryptocurrencies, um, and other alternative assets. You know, your businesses, you might be a private money lender. You know, you might have some peer-to-peer lending assets in there. So your portfolio doesn't stop at stocks and bonds, but we don't try to do everything all at once. But again, through fractional shares, we can invest in multiple stock market assets all at once with minimal dollars, with free commissions, with fractional shares, and so on and so forth. So I'm gonna cut it there. That's just some insight, some highlighting on stock market investing. If you need my help in building your portfolio and improving your financial literacy and doing that, and financial planning for your financial future, and planning out your investments. That's what I help people do. So if you are interested in becoming a client, I'm interested in having you as a client. So reach out to me and we will get the process started. and see if there's a meeting of the minds or something that I can help you with, and if you need my help. So anyway, thanks for listening. Please like and share this video. Please subscribe to this YouTube channel. If you need to holler, shoot me an email, twhite@hoodoofinancial.com, and comment on this video even. But holler.